Are we in a bubble? If you've been watching the news, you probably think you know the answer. Everywhere you look, people are saying artificial intelligence is a massive bubble waiting to pop. Just look at the stock market. The S&P 500 is up almost 50% over the last 2 years. That is absolutely bonkers. And who is responsible for this? It's not everyone. It's just a handful of companies, the Magnificent Seven. And the king of them all is Nvidia. This microchip company is powering the entire AI revolution. Its stock price has quadrupled in 2 years. It is now one of the most valuable companies in the world. To put that in perspective, investors currently think Nvidia is worth more than 22 Disneys or 5 JP Morgan Chases combined. It makes you nervous, doesn't it? Because we all know how this movie ends. If this is a bubble, it's one of the biggest we've seen in years. And eventually, bubbles pop. Prices crash down to reality. People lose their money. People lose their jobs. We saw it in 2000 with the dot-com crash. We saw it in 2008 with the housing market. But what if I told you there is a plot twist? What if I told you that this AI bubble, even if it is a bubble, might actually be one of the best things to happen to our economy? What if I told you that we might actually need this bubble to get bigger? Welcome back to Foxonomics. Today, we aren't just asking, will it pop? We are going to look at a provocative economic theory that says some bubbles aren't as scary as they seem. In fact, this market delusion might be the exact fuel our future needs. Part 1. What is a bubble anyway? Before we panic, let's define what we are talking about. You might be surprised to learn that spotting a bubble while you are inside it is incredibly difficult. One of the most famous economists in the world, Eugene Fama, a Nobel Prize winner, doesn't really believe they exist. He believes markets are efficient. If Nvidia is expensive, it's because it should be expensive. Fama says the word bubble drives him nuts because you can't predict when they will end. But in the other corner, we have researchers like Robin Greenwood from Harvard Business School. He says, come on, when people at the gym are giving you stock tips, that is a bubble indicator. Greenwood and his team looked at nearly a century of data to find clues. They found that while there isn't one slam dunk indicator, there are 4 clues that usually appear before a crash. Let's check the scorecard for AI right now. 1. High valuations. This is when prices are way higher than earnings. Right now, Nvidia's price-to-earnings ratio is in the 40s. The average is usually in the 20s. So, check. 2. Volatility. Are prices jumping around wildly? Yes, absolutely. Check. 3. Issuance. This is when companies sell new stock to raise cash. Surprisingly, we aren't seeing this much yet. Big tech companies like Microsoft and Google are so rich they don't need to sell stock to build data centers. So, no check here. 4. Acceleration. This is the strongest predictor. Do prices go up in a straight line, or do they whoosh up exponentially? Recently, stock prices have been going up, but maybe not with that insane whoosh we saw previously. So, the verdict? It's mixed. Greenwood calls it an early bubble. But here's the thing. Whether it pops or not isn't actually the most interesting part. The interesting part is what the bubble leaves behind. Part 2. The silver lining. Productive bubbles. Let's time travel back to the late 1990s. The dot-com bubble. It was a crazy time. Any company with .com in its name got millions of dollars. Investors were throwing money at anything related to the internet. During that hype, telecom companies spent billions of dollars digging up streets and laying fiber optic cables across the world. They thought we would all need massive bandwidth immediately. Then the bubble popped in 2000. The Nasdaq plunged 78%. Companies went bankrupt. And all that fiber optic cable, it just sat there, unused. They called it dark fiber. At the time, it looked like a colossal waste of money, a total disaster. But wait a second. What happened 10 years later? Streaming video appeared. YouTube, Netflix, social media. They all required massive amounts of data. And guess what made that possible? That wasteful dark fiber. Because the cables were already in the ground, broadband became cheap and accessible. That bubble actually catapulted us into the modern digital era. Some economists call this a productive bubble, or a bubble with a silver lining. The theory is simple. Some technologies are so expensive and risky to build that no rational person would invest in them. Who would build a railroad across a continent before knowing if trains were profitable? Who would wire the entire ocean with cables before Netflix existed? The only way to get society to pay for this infrastructure is through irrational exuberance. We need a bubble to trick investors into funding the future. Now look at what is happening today. We are worried about the AI bubble, but look at what the money is actually buying. It's not just code. It's physical infrastructure. Companies are spending billions to build massive data centers, manufacture millions of advanced GPUs, and upgrade energy grids. If the AI bubble pops tomorrow, let's say we realize chatbots aren't as profitable as we thought, what happens to all that stuff? It doesn't disappear. Just like the fiber optic cables, those data centers and supercomputers will remain, and that computing power won't be wasted. It could be used for drug discovery, climate modeling, or scientific breakthroughs we haven't even thought up yet. There's an economist at the Chicago Fed named Gadi Barlevy. He discusses this idea that bubbles can fix a market failure. Normally, companies underinvest in R&D because it's hard to capture all of the value. But during a bubble, investors throw money at R&D. So, by encouraging what looks like excessive creation of assets, we might actually be doing something great for society in the long run. It's like two wrongs making a right. Part 4. Lean versus clean. This brings us to a major debate in economics called lean versus clean. Should the government lean against the bubble, meaning try to pop it early to stop the madness? Or should they clean, meaning let it ride and just clean up the mess after it pops? After the housing crash in 2008, everyone wanted to lean. That crash was devastating because it involved banks and regular people's mortgages. When banks fail, the whole system freezes. But the AI bubble is different. Who is funding this? It's mostly venture capitalists, private equity, and cash-rich tech giants. They aren't borrowing from your local bank the way homeowners did in 2008. If an AI startup fails, a billionaire loses money, but the financial system probably won't collapse. So if the systemic risk is lower and the potential reward is a massive upgrade to humanity's computing power, maybe we should let it run. Maybe we should let the bubble inflate. So are we in a bubble? If you look at the volatility and the hype, probably yes. Should you be careful with your money? Absolutely. But as a society, this might be exactly what we need. History shows that innovation is messy. It's fueled by hype, greed, and delusion, but sometimes that delusion leaves behind the railroads, the electricity grids, and the internet cables that power our lives for decades. The AI bubble is currently building the engine for the 21st century. And the best part? The investors are paying for it, so you don't have to. So next time you see a headline about AI being overhyped, just smile. They might be right, but that hype is building our future. Now, while bubbles might be good for society in the long run, they can be dangerous for your wallet in the short run if you don't know what you're doing. You don't want to be the one holding the bag when the pop happens. If you want to understand how to navigate these markets safely and protect your capital, I have a specific video for that. If you want to learn how to invest properly, I explained it fully in this video right here. Go check it out, and I'll see you there. Thanks for watching Foxonomics. Keep thinking.